Hello, ladies and gentlemen. Thank you for standing by and taking the time to join us for today's webcast, PPP Payback Process. During the presentation, all participants will be in a listen-only mode. Please use the chat function to submit your questions, which at the end of today's presentation, we will be sure to address. Without further delay, Terry, can you get us started?
Welcome, everybody. I'm Terry Rivera, the Executive Director of ASA Chicago. Thank you so much for joining us. Our presenters today are both proud ASA Chicago members, Todd Sprang from CLA and Dave Nelson from Wintrust Commercial Banking. Todd is a principal in the firm's Oakbrook office. He has more than 25 years of experience performing audit and consulting services for a variety of clients in the financial services industry. Dave is an Assistant Vice President of Wintrust Construction, Engineering, and Architectural Division. Dave has been with Wintrust for 8 years. Over the past 2 years, Dave has been partnering exclusively with contractors, providing financing solutions to help achieve their operational goals and objectives. Thank you, gentlemen, for being here and sharing your expertise. Let's go ahead and dive in.
Thank you very much, Terry. I appreciate it. I'm going to back up a little bit and just say thanks to ASA for having us as presenters today. We're glad to help out. A little disclaimer, if you want the plain English version of this from a CLA standpoint, I usually say that if during today's broadcast I say anything that's spectacularly brilliant, then I credit that to CLA, to Clifton Larsenell, and if I say something that's wrong, those are the remarks of myself and myself only, and the firm takes no responsibility for it. So, Dave, how are you doing today?
Doing great. How about yourself, Todd?
Pretty good. Hey, what I thought I would do just to kick us off here at the beginning is just run through the agenda really briefly. Tell the participants what we're going to cover today. And we wish today that we had some of that guidance on forgiveness, specific guidance that we've been expecting for a while, but we don't have that. But here's what we have. We're going to start with a little bit of an overview over that entire PPP process, right? We're not going to spend too much time there, but some time there. Then we're going to talk about really briefly the application process, how that went, and some of the implications of that on the forgiveness process. Then we're going to focus primarily on repayment and forgiveness. And then the fourth part will take a little time to cover the unforgiven loan amounts that remain at the end of that forgiveness period. And then at the end, we're hoping to leave about 10, 12 maybe minutes for some Q&A. So if you're coming up with questions, submit those questions, or we'll have an opportunity to answer those at the end. We want to make sure that we give you some time. And we recognize that there probably are some questions, so go ahead, don't hold back, get them in, and at the end we'll make sure we have plenty of time. Dave and I don't plan to be those speakers that run past and then don't even have a chance to answer one question. So with that, let me just give that quick overview of the whole PPP process, just so that you know that as we're talking about specific parts of this process, you'll know where we are. So first, that process was the application process. We've got another slide that'll delve a little more into that. But then that application process ends with the funding of that PPP loan. And right at the funding of that PPP loan begins the payment deferral of 6 months and that 8-week period that everybody's familiar with that counts in forgiveness. Then the next process is that forgiveness process, where there's an exchange of information between the borrower and the lender and the SBA that ends up in that ultimate forgiveness process for the borrower. And then there's that remaining tail end loan amount at the end that I referred to. And that's the fourth phase. So in today, we're going to focus a little bit on phase 1, primarily on phase 3, with some discussion too of phase 2, because phase 2 and 3, from your perspective, they work so closely together, since it's that information gathering period and then that reporting or forgiveness processing period. So here's the application process in a little more detail. So we know that prior to that process, as borrowers, you're gathering information and putting together your application. That application then gets submitted to the lender. The lender evaluates that application, goes through an internal approval or underwriting process. Even though that was expedited, there was still an underwriting and approval process that went on there. And then once that happened, then the lender submitted the process through the SBA system to the SBA for approval. And then at the end, that resulted in the signed note and funding. As I look at that, Dave, what are your general thoughts about how did that process go? Because I know coming into this even, we thought we had certain expectations maybe of that process from your perspective. Can you share just that Wintrust? That wasn't a time period when you were just sitting feet up on the desk just watching things roll through electronically without much to do, was it?
No, absolutely not. You know, it was all feet on the fire at that point. I'm really proud of the Wintrust team. When they released the Paycheck Protection Program, you know, we had no guidance whatsoever. We kind of knew what it was about. Our team put together an internal portal to take applications. Now, the deadline for the submission was April 3rd, and we only had a week to prepare for all of this. So coming into April 3rd, you know, we still didn't have our online portal ready. We're still going through our due diligence, and by the evening of April 3rd, we were able to accept all applications from a lot of our borrowers. And in fact, I think we took in about 4,000 that evening, where we had to close down our portal because, you know, we couldn't funnel them all through. So we worked all the way through the weekend basically in order to process this. I can only speak on behalf of what I experienced, and it is interesting. We didn't have any guidance whatsoever on how to review these applications, what information they needed to provide in terms of payroll. So we basically went on the fly. We woke up Saturday morning with, you know, 4,000 applications and threw our hands in the air, like, what do we do? Not having access to the e-trans system to even submit for SBA approval. So, you know, we really worked around the clock in order to, you know, service our customers. We almost considered ourselves, you know, front line, you know, in terms of the banking.
Absolutely, I can appreciate that. And I can tell you that what you just shared was the experience of most lenders out there. It was one of those where you were just having to kind of fly blind because the program started so quickly without rules in place. And if that sounds familiar, well, that's kind of where we are in the forgiveness process too. So as we go along in our presentation, there's some similarities there, I think, between this process, and that's why I brought it up in that process. Let me also say that I think from a borrower perspective, they expected, maybe a little bit surprised, that the process varied from institution to institution. If you were dealing with one of the very largest institutions in the United States, you may have had a different process and even signed note agreement than if they had gone with you guys or somebody smaller. So there were some variances there that I think only kind of came to light at the end of the process. And maybe, and those things we'll touch on again at the end, because I think they can come back at the end too, with respect to, you know, how things progress. So let's move on to a little bit of, you know, we got round one that you were talking about with that early application process, April 3rd for entities. Then you went to self-employed or independent contractors that started on April 10th. And so that was all in round one. And now we got to round two. So from your perspective, the second wave, what's the same, what's different between that first round in early April and this round in late April, early May? Are you seeing some things that are the same and different?
So, I mean, during round two, certain applicants were able to qualify underneath the 500 employee range. They provided also additional guidance in terms of if you were in a certain industry or NACE's code, you were also eligible to apply. During round one, we really stressed, you know, getting all of our customers through in terms of the approval process, because we didn't know if funding ran out. Banks didn't want to be held liable for putting you know, the larger loans through first and then taking on our community banking customers last. We really went in a pecking order of, you know, first in, first out, which really benefited our customers. Fortunately, we were able to get majority, if not 99% of those through round one, and only had, you know, a few stragglers that were held up. Well, one fact I did notice today was during round one, we funded $349 billion on I think 1.7 million applicants, and round two we're at 180 billion funded, over 2.2 million applicants funded. So that was pretty striking, and I'm not sure if that includes a lot of the payback due to the safe harbor rule, and if that's a net effect or not. So we'll have to see, but I thought that was interesting.
Yeah, let me tell you what I'm hearing overall too on our side is because I'm part of a group here at CLA that sees maybe something similar to what you're experiencing too. Just I'll see it across the country too from our perspective and working with our folks. And one is what's the same from our side is that the rules are changing. The rules have not been set the whole time. Guidance just continues to flow. And I would have thought or would have hoped that round 2 would have been there would have been more clarity, but because maybe the rulemaking or guidance would have stopped with respect to applications, but it seems like it keeps coming out and it keeps looking back. I'm going to give an example of that. I think last night a question came out about employee headcount, like in the FAQs 44, and that kind of goes back, and people had to already make decisions in the application process in round 1 and even in round 2. So now to come up with guidance that talks about how you should look at employees of affiliates, or I think this latest language pulled out their location, their geography, like primarily located in the U.S. and you start looking at that, and it's kind of like you're really aiming at a moving target the whole time, even in round 2, just like round 1. So that was a bit of a surprise for me. And I think, like you said, I think we're seeing still a high demand, but dollar amount per loan has gone down on the second round versus the first round, and that seems to be consistent all the way across the country. So.
And Todd, to your point, it almost seems like round 2 and round 1 is just a complete blur. Not only were we not sleeping, working around the clock, but literally the guidance changed, prior to round 1 into round 2, where the forgiveness period was originally May 1st to June 30th, and then it turned into 8 weeks upon disbursement of the loan because they didn't want banks playing favoritism or borrowers working up their backlogs. In terms of that, and SBA qualified small businesses, a tangible net worth underneath 15 million and a net income underneath 5 million, which averaged over the last 5 years. So those were just another, guidance that we received. And the corporate, if you're owned by a major corporation with subsidiaries, the maximum loan amount would be 20 million on that part as well.
Yep. I think, and that's going to turn to, that's where I think if I look at an overview of this forgiveness process, I think we're going to see some similarities as we start to talk about that. It's because I look at it as a bit of a very similar process to that application process. So let me walk through that a little bit. Let's transfer over to that forgiveness process at this point. Because I think just like there was data collection and applications on the submission side to get the loan, there's a borrower collection process over this 8-week cover period that occurs, and an application for forgiveness that can look a lot like that. There's no, as far as there's not a lot of guidance going on in the process, just like in the loan application process on the front end. So borrowers are just having to gather whatever data they can and start to try to prepare the best they can for forgiveness, knowing that they don't have rules. And like I alluded to before in the application process, where the lender evaluates the application and then submits to SBA, you've got this second part of this approval process on forgiveness, is that it goes to the lender. They've got 60 days from the receipt of the application from the borrower to conduct a review or an evaluation process, maybe the forgiveness equivalent of the underwriting process on the loan origination side. And then they submit a reporting package to SBA, and SBA's got a 90-day timeline to evaluate that and have some back and forth with the lender, and that all impacts the borrower. And I think, again, this may sound like a very uniform process, but I think there's going to be some differences institution to institution. As lenders collect those applications, they're going to see a variety of information types and submissions from borrowers, and then there's going to be they're going to create uniform systems that may be a bit unique, or information requests that may be a bit unique on each lender side for submission to the SBA. But as I as I think about and talk about that process, do you have any insights as to how you're preparing it at Wintrust, Dave, on how that might look from your side? Do you see it any differently or anything from based on what I just covered?
You know, I to your point, Todd, it'll vary from institution to institution, and the SBA honestly made a right call in putting this process in the hands of the banks. Just an example would be the EIDL loan that you applied directly with the SBA. You know, a lot of the applicants haven't even heard back yet, where the goal of this program was to get the money in the hands of the people, which the banks took charge and were able to do so. Not knowing the guidance, requesting information that we thought we might need. Sometimes it was difficult because, you know, we're relying on a lot of certifications and attestations from these borrowers, and we're used to underwriting the credit decisions. So, you know, issuing a $2 million loan where half of the payroll costs are hearsay from the borrower was very difficult and hard for us to kind of recircuit upon, you know, an origination of the program. And that wasn't up until but I think the 24th that the SBA actually released guidance on what information is required. But I think even well into the program, about a week into round one, you know, they've said, you know, rely on the borrower's attestation. If they say this is the amount of payroll costs, you know, go with that as long as there's supporting documentation. So when the applicant would submit this information to us, you know, we gather it, we approve it, and then we go through this E-Tran process to submit it to the FDIC. And I have a feeling it's going to be the same direction with the SBA forgiveness period. Or if the SBA decides to provide a forgiveness application form, or they just intend on the banks to create one themselves, and relying on the borrower's certification and attestation, the bank will gather this information just like they did in the application process and determine basically a number that this is for the forgivable amount. So you have $1 million loan. 750 is forgivable. The remainder would be 250, and it would be based on the initial amortization. Now, I believe the banks have 60 days from the point when we receive our application to determine the amount of eligible forgiveness, and then we would submit that to the SBA, and then the SBA would have 90 days from that point. So we're looking at, you know, 5 months down the road before we get a formal approval or potentially an audit. However, I do believe that the banks will, or the SBA will rely on the banks in terms of the package that we submit and the approval that we request.
Yeah, I think you're right. I'm going to move on to that next slide because we've already started to touch on a few of those things, I think, with some of the similarities and differences. I think one of the similarities, and you've touched on it, is while those processes might look similar, I think the turnaround process, the turnaround times that we're talking about on on the SBA side and on the lender side were really fast versus the forgiveness process that's going to take a little more analysis. So, you know, there was some discussion yesterday. I was on with a group, and they were thinking about when do they recognize forgiveness. And I think there was even some thought that based on the process that they might, just like the application and the loan disbursement process had a pretty quick turnaround. I think they thought that the forgiveness process might be a little quicker than what you and I had just covered. Because if you make a submission, if you get through your 8-week period, and you could be looking at into October or November before you understand or you obtain what's really that forgiveness amount from the institution. So I think time frame is one of those things that we're talking about. I think the other thing is there's still so much uncertainty with these rules and processes that it's so open that it's like you're going into this process with a lot of unknowns. And so as I'm a borrower and trying to put myself in their shoes and gathering the information that might be necessary for this initial application and not knowing what that application looks like or not having a form to follow can just leave my head spinning with respect to what I'm supposed to collect. And then there's so many open questions. And we'll cover a few of those later, but I think that just makes it a tendency to like gather as much documentation as you can, just hoping or wondering if in case you need it in that process that you can put your fingers on it and kind of address that, you know, but rather than wait until the end and see what the list looks like and just to delay your request for forgiveness even more.
Right. I mean, I 100% agree with that. And, And this would be the second bailout that I've been involved in with banking. Previously, I was involved with the FDIC law share acquisitions, where Wintrust acquired 8 failed banks. And it was the same process where the FDIC ramped up because they had to monitor, the banks, our charge-offs, any expenses that we had on these acquired loans. And the banks would basically have to provide certain expenses to the Fed on a quarterly basis and an annual audit. And the Fed wanted their money back. Any recoveries we received from a charge-off, they had a 10-year period where it was the recovery period. So in my opinion, I have a feeling the SBA is going to have to ramp up to monitor all these loans, but then at the same time, they're going to want to get their money back. But are they already creating fear with these borrowers in terms of the safe harbor? Because what is a necessity, and we'll get into this later, and what is a sufficient amount of liquidity? I mean, those are all uncertain answers, and does it defeat the purpose of this program altogether? Because if a company has to dip into the line of credit, then are they going to go into debt, or are they going to fire their employees?
Yep, I think you're right. I think that's a good parallel that you drew to between the indemnification process that you were involved with and this process, because I think from a lender's perspective, and I don't know how much, I think from a borrower perspective, they think that the SBA, this is 100% guaranteed, that's rock solid, unpenetrable. And you and I know that there's things that you have to do as a lender to, in that case, protect your indemnification, right? Or in this case, protect that 100% guarantee that you're getting from the SBA, because we know that it's intended to be, and most likely will be effective, completely effective. But there's always some exceptions to the rule, and I think that's the apprehension on the lender side that lenders came into this process with, that borrowers maybe didn't anticipate. But I think they're getting a feel for it now, because just like you maybe as a lender came into this a little bit apprehensive because to maintain the SBA guarantee and do everything to stay on the right side of the SBA, the borrowers are understanding that unlike the beginning of the process where it looked a lot more like a grant with a potential little bit of loan, there's strings attached that kind of come in, and we've learned that over the last week or so, and that there's things that the borrower has to do to protect themselves to make sure that they achieve that forgiveness, and that this looks a lot more like a grant with a loan component than it does just a straight up loan. Because on the worst side of it, like we just said, they could be viewed as unintentionally doing something wrong, and there's a little bit of fear out there, I think, along those lines. So what if we transfer over to that and have a little bit of a discussion about that safe harbor? I'm going to tee this discussion up for us by saying that, again, we got an extension. So I revised this slide on the fly to where we now have a revised May 14th deadline for that safe harbor. And so just to recap that was a question that came through in the FAQs and I know most people will liken it to certain companies, and I'll mention, I guess names will be names, but I mentioned like the Shake Shack scenario, where after obtaining the loan, there are some borrowers that came out and said, well, I'm revisiting the certifications. Now that I better understand some of the implications of taking this loan, it's not just cheap money. The certifications are taken seriously, the expression of, say, financial need, or I'll say access to other funds, or the commitment to keep people employed. That was something that they didn't have a lot of time to evaluate at the beginning of that process. So then you have this, might have a reconsideration to say, well, and I should add also, not only that with the certifications, but also the fact that then when the borrower's names or a little bit of information about them, not all the information in the application process, but just some of the general information about the loan was going to be available to the public, whether via release from Treasury or just from a Freedom of Information Act perspective. You looked at, well, now people are going to know that I took this, so I'll get some maybe media scrutiny or or scrutiny from the general public, and then I've got these the certifications that could be questioned. And so that whole process kind of started with the comments from Mnuchin about revisiting and looking at the full review of loans over 2 million. So then came out this safe harbor language. And so I'm looking at what are some of the considerations as this deadline approaches, this extended deadline that now goes to the 14th. I'm looking at it maybe did what it was intended to do, and that was give an opportunity for borrowers to return the funds in total, and it's surrendering all the funds back by the 14th in exchange for the fact that if you do that, then all of your certifications at the time you made the application would be assumed to be true. So that's the safe harbor. There's no partial, it's a all or nothing kind of return the funds by that date and your certifications will remain. And then if you don't, then you're held to your certifications, but you can always make other arrangements, which I think we'll also cover later. But when I look at those, it's really tough, I think, to the situation to put yourself, you have to kind of put yourself back in the shoes as a borrower and can say, what was going through my head that I maybe didn't document at the time that I made those certifications? How was I evaluating my cash flow? How was I evaluating the market? I don't think anybody at that time knew the duration or extent of the pandemic that ended up creating the financial or I'll say economic consequences that came out of it. So I think but you have to do that in order to assess your certifications at this point, is kind of go back and say, what was I thinking at that point, and try to get it down on paper. And so maybe I'll pause there and say, from your perspective, I know borrowers are asking a lot of questions. Are there any thoughts on what I just said, or what your borrowers are expressing as some of their considerations and how they're approaching this deadline and whether or not to return funds?
Right. So there is a lot of concern out there, and what I can tell you is, our initial check-ins when this whole pandemic began and they issued the stay-at-home order it was almost business as usual. But as it continued, jobs get shut down, businesses impacted. However, construction is an industry that's generally the last one into a recession and the last one out. So we don't know the uncertainty or the length of this recession and how it's going to go. When they discuss, different forms of liquidity, what does that mean? Construction's a risky business. A line of credit is generally used for qualification purposes and for operating capital. However, when you look at it from a surety standpoint, they don't want their customers tapping into their line of credit. If they have no liquidity left, then they're not going to continue backing your backing support, for future jobs. I mean, we're certainly seeing the impact on future backlog, although the work is in place right now. I mean, who knows how long this is going to continue? Without people on the street, municipalities are losing tax dollars where there's not going to be that, amount of funding in the future for jobs, because you have to replace that backlog as you go. So in my opinion, we've had customers return these funds, but very few, and they're the GCs with, say 20 million in cash sitting on their balance sheet. But other than that, in my opinion, I feel that this is a necessity, and that other source of liquidity would just determine to your business. Your business didn't require you to go outside to your personal funds to replenish this business. If you own multiple businesses, why would you grab from one to replace another? And we don't know the uncertainty of how long this pandemic is going to go, or how long it's or is going to impact us at some point. One point to make is that lost my train of thought. Sorry about that.
That's all right. Let me take off on one thing that you said, and that is, I think you're right. There's just because you had some liquidity, and let's say you had some cash reserves, let's say you also had access to a line of credit, and yet you made the determination to apply for and receive PPP loans or loan. I looked at it as, I think you have to look at it on a global basis and say, you know, if you had an overall plan, PPP funds are very specific. I think it's formulated like a grant. You can only use it for specific purposes. So that could only satisfy part of your plan, right? That doesn't cover general working capital or other expense needs that don't qualify under PPP. So you had to look at it on a global sense. You had to say, well, I can use PPP for payroll and a few of these other expenses. I can use my existing cash and line of credit for these other things. And these are the things that are going to get me through to the other side of this. And what the other side of this is, that time frame was a real unknown. And like I said, who could predict kind of revenues or when people might pull contracts or stop revenues at any given point based on what's going on? So there was a lot of uncertainty there. So I think it's an oversimplification to say just because folks had cash or a line of credit that it would have made them not have financial need in such an uncertain time. And then the other point that you mentioned was, let's say I own several businesses. Well, I also don't think you could look at that one owner and for each individual business, they could look to that one owner and say, well, I had access to that person's capital. They could have injected more capital. Because if I've got 4 different businesses and they all looked at it in a silo, they all may say they had access to adequate capital. When in fact, if in the aggregate you summed all those needs up and looked at the owner, they may not have had the wherewithal to fund all those businesses at the same time. So I think short of doing a big global cash flow like that on a single owner with all the entities, I don't know how you make that clear determination. So I think that's just a difficult exercise.
Right, and who's to say that you may not have sufficient liquidity now, but if you could justify the uncertainty, in my opinion, why return it by May 14th? I mean, you can use the source of funds and hold on to those funds and may not apply for the forgiveness at the end of the period. We necessarily don't have the guidance on this at this point in time, but as a security net or safety net, hang on to it. Have that liquidity because it may be needed down the road. And for the SBA to put a hard deadline on that right now, I seem as unfair. And then in addition, say you're a contractor that has, done business and managed your cash flow over the past couple of years and has done quite well. However, the same competitor, took distributions, blew their cash. Now who's to say they have a need for it and you don't? So you're ramping up your competition and putting yourself at a different level. That seems a little bit unfair.
Yep. I think what we're expressing too is there's a big difference between what your visibility was into expected revenue and then a month later what your actual revenue was. I don't think we'll know. I don't think even if you wanted to do a look back, you couldn't do an accurate look back until 6, 9, 12 months from now. And even then, I think the further you go out, the harder it is to predict the further you go out. So I think, at least in my estimation, I think what you're saying too is you've got some ability to make the cause and use the funds.
Yeah, exactly. I mean, we'll be waiting on 6/30 financials, which we won't receive until, September-ish.
Yep. So if you decide at this point, then make that decision that not to return the funds, keep the funds. You're comfortable with the eligibility and certification process that you made back at origination. You may not have documented it at that time, but you got comfortable and you documented it at this time. And then you look at you're halfway through this 8-week cover period and you're still waiting for guidance. So there's a few things we know. There's a lot of important, I'll say, unknowns. And then my third question that I've got there is what could significantly reduce forgiveness? If you want to talk a little bit about, from your perspective, like what in general do we know and what from your perspective might be some of those key unknowns?
Okay, certainly. So, what we know is that, 100% of the loan amount can be spent on payroll. And we strongly advise all applicants to spend 100% of it on payroll, at least 75% of it. And the remaining 25% can go to ancillary costs such as rent or mortgage interest, as well as utility expense. Some of the, I guess what could significantly reduce the amount forgiven is if you reduce the head count from the period of February 15, 2019. So we'll be looking probably at a 941 around our first quarter from last year, and compare it to this year, which potentially could be based off of a 630 941. They're going to look at it as a percentage. So say you had 10 employees employed last year, now you have 8, 80% of that loan would be forgiven, and then they would calculate it that way. Now, however, there is an exception that if you increase your head count as of 6/30 to what it was pre-COVID period, then 100% of the loan amount could be forgiven. Now, we don't necessarily have official guidance on this, and these are all speculations. As we've always said, more to come, and we're continuing to wait on guidance from the SBA.
Yeah, and I think what you mentioned about spending on payroll, that one's good. What we do know is that 75-25 split, right? And most people are familiar with that. They're familiar with the broad categories of what would fall into that 25%. When you look at interest, you look at rent, you look at the basic utility costs, right? What do we not know? We don't know what exactly gets grouped into that category of utilities. The common things that we talk about, we know, water, electricity, we know phone. There's been the question, well, what does phone mean? And I'll just call it, because I just like to use the term telecommunications or communications, because from my perspective, that can mean things like my landline telephone service, my mobile telephone service, and my internet service, because also so many instances today, those three things are linked. Everything's coming through from that internet base. It might not include those ancillary things that are tied to, like any software or any programs that are dependent on the internet, but at least it's kind of those. Because just yesterday, again, I answered a question related to I just answered it this way when they said about mobile phone services. I said, in today's environment, what's the difference between a landline and a mobile line in terms of how you utilize it, but why would you treat it any different when you look at that perspective? I think maybe some more of the unknowns on utilities might be fuel. There's been some discussion about fuel and what tax regs come into play in the analysis. That's where I think we'll get some important clarity on that. The other thing might be just the order of the calculation of what applies that. What do you apply that 75-25 to? I think in broad terms that may seem pretty easy, but when you delve into the details and look at the language in the different documents, that's one part that's tough. As I know we have that job and you have that job, Dave, of trying to interpret that guidance and instruct people on what it means, is that when you compare the different pieces of guidance, they might use just slightly different terminology that might create some uncertainties in how to apply like the order of things or what exactly does that mean. So I think those are difficult. And I think you're right on the last point I'll mention is that when you look at what could reduce that amount of forgiveness, I look at things that are beyond your control. I think about the type of business that you have, the geography that you're in. I mean, let me start with geography. I mean, things are going to open back up. The same business might open up differently at different time periods in different geographies. So the same exact business in Florida might open up at a very different time or have different results of a production that will allow to maintain that headcount versus Illinois versus California versus another state, right? So geography can play a role. The type of business can play a role, because just this week here in Illinois, the governor kind of announced the kind of phases and what types of businesses might be able to open in each phase. Well, I know the restaurants weren't happy with what phase they were put in, because being in phase 3 versus phase 4 can make a significant difference as to the type of revenue that you can generate, and also the type of headcount that you can maintain, how many people you could support and pay and keep busy. So I think those are beyond the control. And unfortunately, that loan amount that base amount, that's set. But these other variables are the things that can impact that 75-25 split that we're talking about that gets applied to that base loan amount. So I don't know, any other thoughts about that, Dave?
And I think that 630 day is going to be an important day because, I mean, like to your point, Todd, the economy hasn't been open up for restaurants or salons, bars. So they're not going to be able to take advantage of this full program. Will the SBA extend the forgiveness period for those particular companies? I don't know. I think it would make sense to do so because they can't take advantage of this now. You know, one other point that we've seen with customers is use of funds. A lot of our customers had asked, you know, if they should open up separate accounts, you know, for this a strong paper trail. However, we have other customers that are on a loan suite where we deposited into their DDA and it paid down their line of credit. They wanted to reverse that, but you know, our direction was, you know, use it. It's the lowest cost of funds at this point in time. You know, we're not going to look at a direct paper trail of where the loan proceeds went. You know, it's cash. You know, how can you actually monitor that? You know, and at the end, you're going to submit a package to us and we're going to give you a hard dollar amount of what's forgiven. So necessarily what you spend your loan proceeds on won't necessarily matter, but as long as those expenses are included and you're able to justify what those expenses are, will determine the amount of forgiveness.
I think that's a great point, Dave, because I think there was some sense at the beginning of this process that a separate account would lead to better or more accurate tracking. But the truth is, the way that, say, payroll disbursements come out of other accounts and that are set up, or that components of a spend may be allowable, but not entirely. When I think about payroll, like you transfer an entire amount to pay payroll, but not all amounts in that transfer end up being, you know, included in forgiveness. So just, I think better tracking is better, is the goal, and that can be achieved without a separate account. If I go over and look at that timeline, and we talked about it, and we've started to touch on this already, but what do we know versus what we not know on timeline? I think one of the things I talked about before is it's going to probably be longer than what you initially think as a borrower. But is there anything that you're thinking about from your perspective, Dave, on that forgiveness timeline, other than just maybe the general 60-day and 90-day requirements for the reviews of the lender and the SBA?
No, it's interesting. I mean, we're already in week 3 for some of our customers, and we have no guidance on the forgiveness. In terms of the 60-day, 90-day period, we have 6 months of deferred payments where it would just accrue interest only. So we do have some time. At the end of the 8-week period, you know, we're at 2 months, and we have an additional 3 months to determine the amount of forgiveness. So that essentially gives us 5 months before we can indicate to the borrower, all right, here's your amount forgiven. So we do have plenty of time. It's just a matter of making sure that you're tracking the right expenses. Now, once we submit that number to the SBA, they have 90 days to approve. The loans are set on an 18-month amortization after 6 months interest only. So if you're forgiven 75% of your loan amount, you may pay that off in approximately 2 monthly payments and totally exhaust that debt if you do have the forgiveness portion.
Yep. And here's a couple of things I'm thinking about in that process as I think broadly across borrowers and topics that have come up, is that I think that SBA review process is going to be, you know, they've got, I'm envisioning, and again, pure speculation, but envisioning that there's going to be several potential levels of review. They've already said that those loans over $2 million would, in this forgiveness process, go through the highest level or most detailed level of review, what they've termed as full review. Some people call that audit. I get picky about the term audit, so I say that it's going to be a full review. But there's other levels of review that can occur that could be more expedited. And I think which level of review they choose, regardless of your size of loan, might dictate the length of that process. If a forgiveness application gets submitted for full review, I can expect it to take a little longer. Now, naturally, I think there's going to be some linkage of that between the loan amount itself and the review that it goes through, and that I would anticipate or think it would be likely that a lot of the smaller loans might have quicker review periods just because the amounts are small, the calculations or the circumstances are simpler, versus maybe a larger instance that could take a little more time and more analysis. So that's what I'm looking at with respect to that forgiveness of period. And I think there's going to be potentially, especially with some bigger ones, there's going to be some back and forth, much like the application process. I foresee that during that 60-day period, there might be some discussions about between what the borrower submitted for forgiveness and what the lender's analysis of that forgiveness is. And there'll be some discussion of what I'll call reconciliation before that ultimate lender submission to the SBA. And then I think for the larger ones, there might ultimately be a little bit of back and forth based on that full review process between the SBA and the lender. So then if I look at that whole process, you can expect some differences or potential differences between what the borrower expects at the beginning of the process and what gets granted to them at the end when the SBA communicates back to the lender.
Certainly, and Wintrust in particular, we have over 10,000 applications that we're going to have to review and reconcile in terms of forgiveness. And I can only imagine the SBA having to staff up for this. And once they do staff up, what are they going to do after the fact? They're going to do continual look backs and try to recover some funds. Who knows?
That's exactly right, and that's what I view as that audit process. Is I think there's audits. Those results of those SBA reviews are still subject to audit by like an inspector general or some process like that, where I think there's an additional chance that possibly a year or two later down the line, those will be scrutinized and looked at. I think that's part of that though. I'll leave. That's again pure speculation, but it's one of those things that I think lenders consider in knowing that even though at the end of the process forgiveness is granted, that they still might be on the hook for providing additional information to a subsequent SBA audit and some reevaluation of that SBA review decision. So if I look at that, the last part of that process that we've talked about as we head to the end and get toward Q&A here in a couple minutes is, whatever amount remains as unforgiven, that sits there at the end of that period as a loan, and you've covered that. That's got a payment period associated with it. And so what do you see happening if the borrower at the end is in a position where they're not able to repay that unforgiven amount, where they've been able to make the hires to achieve a level of forgiveness, but their operations just haven't ramped up quick enough or haven't gotten back to the level where they're in a position to pay that loan? Is there any difference between that loan and maybe a normal loan and how you might handle it from your perspective?
That's a great question, because in past, workouts where, we had an SBA guarantee, the bank is obligated to pursue that borrower, and I don't believe there are any guarantors on these, but pursue that borrower for the amounts that are due in order to receive the SBA guarantee. So although the SBA is 100% guaranteeing these, it's not a grant, and if the borrowers don't pay back, you'll have the banks come after you, to fulfill our contractual obligation. Fortunately, when we underwrote these, we wanted to ensure the borrower is able to pay. However, there's no financial analysis, strictly based on payroll and almost a checkbox. However, to your point, Todd, if a borrower has more operating expenses and overhead that they're unable to continue their business, there's going to be a lot of situations where these borrowers can't pay back these loans. And realistically, we don't know what's going to happen because it almost defeats the purpose, of the program.
Yeah, I think you're right. And that's where I come back to maybe the implications of that, because the SBA would be the ones that would ultimately have the recourse, the ability to go after other assets in the event that these aren't repaid. And again, pure speculation. But as I think about it, I think about the difference between two borrowers, one who's stuck to the allowable expenses under the program and made those expenditures, but just wasn't able to do it in a time frame to achieve a certain level of forgiveness. That's one scenario. Versus another scenario of somebody who recognized maybe at a time of the process that they weren't going to be able to spend it all on those allowable expenses and chose to treat it more like a working capital loan and then defaulted on the loan later on. To me, the SBA might be more harsh or might be more justified in being more harsh in that second scenario than the first, just because of what the borrower, how the borrower used the funds or how they adhered to the spirit of the program versus just looking at it as maybe inexpensive borrowings. So with that, I do want to make sure we open it up to some additional questions here at the end. So Terry, I don't know if anything's coming through as Dave and I have been speaking, but there's some comment or there's some questions that we can take from the folks that have been listening to us for the last 50 minutes.
Absolutely. We've got some great questions here, mostly pertaining to what might be allowable expenses. But one of the key questions that has been asked is, when does the 8-week covered period start in terms of payroll costs?
Dave, I'll take a shot at that first. There have been questions because technically, and then I'll let you address it too, because I think I've fielded those questions in general. It begins, the guidance that we were working off of at the very beginning said it would begin upon first disbursement. And to me, that left some confusion because what the heck is second disbursement? You know, because I think this wasn't like a line that you were able to draw on. The lender had, once the application was approved, 10 days to disperse. So I think there wasn't really an opportunity to disperse in waves to change that date. So from my perspective, it's when those loan proceeds hit the account, that's the day that the 8-week covered period began. And I recognize that for a lot of borrowers, that might not necessarily coincide with the beginning of a regular pay period for them. It may have hit at the beginning or at the tail end or in the middle of a various pay period, and yet their allowable expenses related to payroll costs that begin on that date. So Dave, thoughts on your perspective or questions you fielded from borrowers along those lines?
Yeah, and so the initial date of disbursement would begin the 8-week period, and we're kind of confused as whether that will be on an accrued basis. To Todd's point, if it's in the middle of a pay period, do you calculate each day how many people you had on a job? Maybe easier in this industry than others. However, it could be on a cash basis, as long as that you're relatively consistent with the way that you're tracking or what you're producing in terms of supporting documentation. I think that's okay. Same goes for rental expense as well. Would that be the day you paid the rent, or would you be on an accrued basis and how many days you leased your office, during that time period? It almost all equates out evenly which way you go, but you just have to make sure that you're consistent.
Yep, I agree with that.
Perfect, great. Next question is, at what point would a borrower have to pay interest on these loans?
Yeah, Dave, you want to start out with that one and then I can add in?
Yep, so yeah, interest accrues on the loan from day one. However, once we determine the amount forgiven, that accrued interest on that amount would also be forgiven. And then we would probably recalculate the amount of interest on the unforgiven portion, and then that would ultimately amortize out over the next 18 months. However, that's on the full principal amount that was initially issued you guys.
Yep, so interest starts running from the very beginning, but the SBA in the forgiveness process picks up that piece through the time of forgiveness, right?
Yep.
Thank you. There's a number of questions about, as I mentioned, what would be considered allowable. So I'll just give you a few of the questions here in one. Would required union payments be considered allowable? What about a pension payment that was made today but was for 2019 hours? Would that be part of the payroll? And profit sharing, that's another question. Would profit sharing be considered a legitimate expense? And what about additional pay or hazard pay for payroll?
Yep, I'll take the last one. I'll revert back to you, Dave. You may have some guidance that as you've been thinking about it from Wintrust perspective, is that I think like hazard pay, or when we talk about it getting paid an additional rate for in the current environment, I think that's paid. It's like it's compensation, and that's the intent of the program, is to put compensation in people's hands. If you look at that type of pay, I don't think if it's regardless of whether how it related to their pay at the time, as long as it's within the limits, doesn't exceed the $100,000 of compensation for the individual, then I think you're able to include those amounts. There have been other related questions in other industries that may be similar in that, you know, what about tips that people collect? What about commissions that are payable, like in certain industries, like dealer industries, et cetera? That's really part of compensation, and how do those get treated? I think they should get treated consistently, and we would hope that the final rules would support that they'd be treated consistently. But Dave, did you have any thoughts on some of those others? I think they can be, without the specifics, I know they can be tricky, but take a shot at giving broad guidance or broad response.
Yeah, I guess that's a very challenging question to answer without the guidance from the SBA. In terms of a pension payment from 2019, and are you accruing that over the course of this year? Are you choosing to pay yourself a larger pension payment this year because it's included in the forgiveness period? I know general guidance is that, you know, retirement benefits are included, and that's on top of the $100,000 cash compensation per employee. But I can't answer how much, if all, would be forgiven, and I'm sure the SBA will come back with a reasonable payment of, you know, pension or retirement benefits.
Yeah, and I think, Dave, I would add that I think in general, you're looking at the expenses that cover that period from February 15th through June 30th. So it would be tough in some instances to go far back into 19, make certain payments during this covered period, and look at them as meeting the definition of incurred and paid with respect to the period. But that would be my just off the cuff answer on that.
A second question came in about the union dues. Can you specifically address that for us?
Yeah, I don't know the answer off the top of my head on union dues. I apologize for that. I think there's some question also between what's compensation, how does compensation and some of those non-compensation items that get paid go. I would say it doesn't feel to me like it would qualify, but that's just my gut.
You know, I beg to differ. I feel that union dues would be included as eligible expenses or forgivable expenses, because it is somewhat of a retirement package for their employees, as well as payroll costs.
For them from the SBA, they're just waiting to.
We'll get more clarification on that, but we have been advising customers to include those.
Wintrust and another small bank.
Oh, we're getting some feedback.
Yep, and I could see that. I could see what you're saying, Dave, and I wasn't looking at the benefits.
At the end, we reach as to what you will be forgiven, and then they have to send it to the SBA, and the SBA has not.
Sorry, we're getting
Sorry, gentlemen. I'm not sure what's going on here.
But we seem to be near the end anyway.
We do still have a number of questions. I don't think we're going to have time to get into all of them. We will follow up with everybody that has asked individual questions. I'll make sure that we can address them individually.
So
I think that's a great point. I think that we'll take any questions, Terry, that have come in that we weren't able to get to because of the time constraints, and we'll do our best to gather those up and answer them and get those back out to the participants so that they can have the answers to those questions. So thanks to everybody who's been participating with us today. I think that'll wrap us up.
Thank you.
Yeah, perfect. I think everybody on the call knows that the call has been recorded. I will email out the presentation along with our speakers' contact information. So please feel free to contact me here at ASA Chicago or either of our presenters directly. If you have further questions or you just need help navigating through this process, obviously we're all going through this together. I definitely want to thank Dave and Todd for joining us today and sharing your expertise. And for everybody on the call today, thank you for your support of ASA and all the great questions. I will make sure that we do reach out to each of you individually or even do a Q&A sheet so that everybody can see